Hi, hello everyone. We'll start in a few moments when everyone is getting into the zone. Okay. Hi, hello, good morning, good afternoon, good evening, everyone. We're very glad to welcome you again to our session, our current session as part of the Regulation on AI and Web3 workshop series. This particular session is going to focus on regulating Web3, an overview of global trends and challenges, which is co-hosted by the Getting Plurality Research Network at Harvard Kennedy School and the MIT Media Lab Connection Science team. The topic of today comes after a couple of sessions about AI, and this time we're focusing on Web3, and we are trying to get a global overview on current trends and regulation among different countries, and to try and assist to try and provide some clarity on that, and assist you in designing the best policy in your own region and globally. Our aim in this session is to get an overview of a couple of different approaches and countries. We hope to start the session, we plan to start the session with getting an overview on the European approach that will be presented to us by Peter Kirstens from the European Commission on the EU market in crypto asset regulation, the MiCA, which we'll hear soon. Then we will go and get some indication about the US approach, something that we are all very curious about to understand what it is that the US are doing in the Web3 domains. And for that respect, we're going to have Carol Van Cleef to explain us about, an expert from private sector in the US. Then we'll move to the APAC region to try to understand what is the approach on the APAC region and to deep dive into the case study or the case of Hong Kong. And that will be provided by Ursula McCormack, which is an expert from the private sector on those fields. We will make a proper introduction of all speakers later on. And we will conclude the presentation part of the session with an overview about challenges, opportunities, and important questions that we have with respect to technology and Web3. For example, travel rule, interoperability, privacy, and so forth. And for that, we have with us an expert from MIT, Thomas Harjono, that will tell us about those challenges. We will have this webinar in a format of 15 minutes presentation by our distinguished speakers, and we will follow that with 20 or 30 minutes of questions and answers by you. We are going to record the first session of the presentation, but the Q&A part will not be recorded, and you could feel free to put in the chat your question, and we'll try to target them and answer all relevant questions. Please feel free to put them on the chat, and we'll ensure that they will be answered. With that, I would like to first thank my partners at the Harvard School and the MIT Media Lab for hosting that, and we'll move for our first speaker. I would like to invite Sarah, my colleague from the Kennedy School and the Getting Plurality Network, to introduce Kristen. Thank you so much and enjoy the panel.
Perfect, thank you. It's my pleasure to introduce our first speaker. So Peter Kirstens advises on technological innovation, digital transformation, and cybersecurity at the European Commission's Financial Services Department. He has led work on the European Commission's FinTech Action Plan and Digital Finance Strategy, and co-chaired the European Commission's FinTech Task Force. Peter's often referred to as the father of MiCA, the EU Markets and Crypto Assets Regulation, and DORA, the EU Digital Operational Resilience Act. And so with that, I will hand the floor over to Peter to tell us a bit more. Thanks.
Well, thank you very much, Sarah. And as indeed, I'm often referred to as the father of MiCA, it is my pleasure to then also present maybe what is then a bit my brainchild. And I'm trying to share my screen so that my slide deck comes online, and I'm just seeing whether that is working. If you can, yes, it looks like you can all see my screen, so we can go ahead with that. So the markets in crypto assets regulation is a European regulation that really deals with crypto assets, which are an important subset of what promises to be a very vibrant Web3 environment. So I'll speak in these 15 minutes a bit about MiCA, this regulation, but also place it in the context of a broader digital finance strategy which we have. So we didn't just do MiCA, we also have rules on money laundering and terrorist financing in the crypto space, so often called the anti-money laundering regulation and the transfer of funds regulation. We have rules on and regulations and policy on the use of distributed ledger technology in traditional securities markets called the DLT pilot. We also have rules on crypto assets in the area of foreign policy sanctions. We're working on a digital euro, and we also have rules on taxation of digital assets called the DAC 8 regulation or proposals. And so all of this together form our digital finance strategy, of which MiCA is one of the cornerstones. So I'll speak a bit about the design and the structure of MiCA, which is basically has two big elements. One is an issuer regime, so rules governing people who want to issue crypto assets, and then secondly, the rules governing people who provide services to crypto assets, the so-called crypto asset service providers. And then there's a number of final provisions, which I will skip through. So two big areas in MiCA. First is rules governing issuers and offerers of crypto assets, so people who place these things on the market. And important, MiCA only deals with crypto assets that are not financial instruments, that are not securities. Because if they are securities, it doesn't matter whether they are in crypto format or whatever format they take, they are covered by traditional financial regulation. In Europe, this is called, for example, MiFID, the Markets in Financial Instruments Directive. And then secondly, the other big chapter is the chapter on the crypto asset service providers. So people like wallet providers, brokers, exchanges, advisors, and so on. Important to bear in mind is that this is European level regulation. The European Commission, where I work, we are a bit like the executive of the European Union, and we propose the regulation. But it's not adopted by us. It is adopted by the European Parliament and the Council of Ministers. The European Parliament represents the people, the Council of Ministers represent the member states. And these two chambers are our legislature. It is European regulation, and it's therefore made for the European single market to make sure that the 27 member states of the European Union have a common set of rules on issues, so that services can freely move around and service providers can freely move around the European Union. That's called passporting. So if you are authorized to conduct your activity in one member state, you can also conduct that activity in any of the other 26 member states of the European Union. Finally, that's a technicality, it's an EU regulation. That means that it is a regulation that is directly applicable in the laws of our member states. So the member states do not have to transpose it. We have other kinds of instruments called directives, and a directive sets general principles, but member states must transpose this into their national legislation. But when it comes to a regulation, that is not necessary. It is directly applicable, and MiCA is a regulation. What are the objectives of MiCA, of the markets in crypto asset regulation? The first objective really was to create an enabling framework for digital assets. Of course, the European Commission saw that there were considerable risks and all kinds of frauds and investor protection concerns in crypto assets, but we also saw a lot of opportunity for a new dynamic to power Web3, to raise money, for example, through initial coin offerings that we saw, to facilitate payments, financial inclusion. So a number of opportunities that are offered by crypto assets that we wanted to enable. But we wanted to enable this by providing legal clarity and certainty. And we also wanted to assure, we're the financial services department, we wanted to assure financial stability and market integrity. Crypto asset markets were rife with practices that were a bit challenging, to say the least, to market integrity. And so the MiCA regulation tries to address this. And then finally, of course, MiCA has a number of important investor and consumer protection provisions. I put there at the bottom of the slide that we are very confident that had the rules which are enshrined in MiCA been in place in 2022, that many of the problems which we saw in crypto asset markets, the failures of a number of firms because of financial conditions, but also because of bad governance and conflicts of interest, the FTXs, Three Arrow Capitals, Gemini, and so on, Genesis, and so on, all of these failures would, in our view, have been prevented or very strongly mitigated had these companies complied with the provisions that are set out in MiCA. So first, and I won't go into too much detail, the design and the structure of MiCA. So it's a very long regulation, it has a number of titles, and I've marked here the most important titles as far as I'm concerned, and I think also most industry observers are concerned. And this is Title 2, 3, and 4, which are about the issuance or the offering of crypto assets. And then Title 5 is about crypto asset service providers. All the other titles are definitions and other provisions and market abuse, but these three titles, so Title 2 to Title 5, are really the core of the markets in crypto assets regulation. So first, the issuer regime, Titles 2, 3, and 4. When we look at crypto assets in the European Union, we really distinguish three categories. Or actually, we have general crypto assets, and general crypto assets can best be described as crypto assets that represent a claim on nothing or no one, that are not backed by anything, and that have not necessarily any intrinsic value. And most crypto assets which we see on the market, of the thousands and thousands which you can find on crypto exchanges, most crypto assets would fall in this category. They are sui generis created, but they are not backed by any assets. They have they're not a claim on anything. They're not a debt instrument because that would be a security. They're not equity instruments. They may have a utility function, but mostly they're a claim on nothing and no one. That's in Title 2. And now we have stable coins, and there we make a distinction between two kinds. We've got stable coins, which are referenced and denominated in an official currency and backed by that official currency, and we call them electronic money tokens. And the issuance of such electronic money tokens is governed by Title 4 of MiCA. And then we have other stable coins, so stable coins which reference multiple currencies, like the original idea of Libra, for example. When Libra was announced back in 2019, the original idea was that it would be backed by a basket of multiple currencies, or tokens which are backed by a commodity or other assets, or any combination thereof. So if it's not backed by anything, it's a general crypto asset. If it's backed by a single official currency of any country in the world, it is an electronic money token. And if it is backed by something else than a single currency, so multiple currencies or assets or a combination thereof, it's an asset reference token. If we then look at, and I've lost my track here, if we then look at the issuance regime, so you see here in these categories, we we've got general crypto assets, then in the green, the asset reference tokens, and in the blue, the stronger blue, the e-money tokens. You see a subdivision there because we make a further distinction, legislation is always complex, between whether the tokens are general or whether they are significant, whether they're very big. It doesn't make a difference in terms of the definition and the legal conditions for these tokens, but the supervisory conditions increase if you are or if you're qualified as a very significant token, and I'll come to what a very significant token is. Most importantly, the issuers of crypto assets have to produce a white paper. And a white paper could be compared to a prospectus in securities law, but it's a simpler version. And we used white paper because that was the term which was very much à la mode in crypto space. And a white paper really is a disclosure document where the issuer has to provide information on him or herself, and also on the crypto asset that is being proposed, that's being offered, the technology used, the protocol used, how many of these crypto assets are there, is there an issuance limit, what it is for, so essential information on the crypto asset. And this white paper must be presented and must be submitted to a regulator of any of the member states of the European Union. If you are issuing stablecoins, so electronic money tokens or asset reference tokens, then you must also do this white paper. You must describe in the white paper how the stabilization mechanism operates, how the reserve will be composed, how the reserve will be managed. But your white paper must be approved. It must be authorized by a supervisory authority. So general crypto assets is a notification requirement for the white paper. For the stable coins, your white paper must be approved. And if your white paper isn't approved, you are not authorized to issue that stable coin in the European Union. So these slides, and they will be available to all of you for your review later on, describes what is the content of the white paper, the content of the marketing material, and so on. So I will not go into too much of it, but if I show you this here, very importantly, there's a number of obligatory disclosures you have to make in a white paper. There's also certain prohibitions. And the most important prohibition is that if you offer general crypto assets, you are prohibited from making any representations as to the future value of the crypto asset. So you can't even make historical comparisons or create the impression that this is a good investment. So you cannot do that, because we saw that people promised to Moon that if you wanted a Lamborghini parked in front of your door, all you needed to do was to buy these and these and these coins, and in a matter of weeks or months, that Lamborghini would be parked in front of your door. We said we're not having any of this. So you are not allowed to make any representations as to the future value, and that the value will increase on these tokens. Of course, for stable coins, you may make a representation that the coins have a stabilization mechanism, and that therefore the value is expected to be stable, and you have to explain what that stability is going to be. At the same time, you're prohibited from making promises on profits. You have to make disclosures on the risks. So you must inform potential buyers, prospective buyers of your crypto assets, that the tokens may end up having no value at all, or that the buyers may find it impossible to sell their token to anyone else, that they may not be able to find a willing buyer for it. And therefore, the tokens may not have any monetary value because no one buys it from it, that they have no liquidity. Or if the token is a utility token, that the utility which is promised may not materialize, may never develop. So there's a lot of warnings, and I would almost say discouragements, that you have to put in this white paper and the marketing material to really warn consumers that this is or can be very risky stuff. Then in the authorization, so as I said, general crypto assets is a notification requirement. The stable coins, the asset reference tokens, and the e-money tokens, they need an authorization. So the authorization license is given on the basis of the white paper, which must be approved by the supervisor. Then MiCA sets also a number of organizational requirements for issuers of crypto assets, but and you'll see here that for general crypto assets offerers, there's not that many requirements. For example, there's no capital requirements, there's no provisions on remuneration of staff. But for stable coins, the requirements are much more detailed. So they must also have capital, and they must have more advanced governance requirements. They have restrictions on their remuneration policy for their top executives, and so on. So that is for organizational requirements. And it continues here also, for example, the stabilization mechanism. Crypto assets, general crypto assets do not have a stabilization mechanism, so obviously you do not have to do anything there, but for the others, it's explained what you have to do in MiCA. Now, if people in the audience are motivated by this presentation and want to study MiCA or want to study this presentation in a bit more detail, they will find a lot of language in here which seems to come from traditional financial regulation, from banking regulation, from securities regulation. And the reason for that is that that's where the language comes from. While this is a regime which is for crypto assets which are not financial instruments, many of the substantive rules are inspired on traditional financial securities rules and traditional banking and investment rules. But we have adapted them to the specificities of crypto markets. As I said, we have significant stable coins and I would say not significant stable coins. And this depends on how many users there are, how many reserve assets are held. So if you have reserves, if your stable coin has a market capitalization or a reserve higher than 5 billion euros, you are a significant stable coin, and so on. And then the result of being significant is that your capital requirements become higher, that you have stricter remuneration policy requirements, that you must stress test your stablecoin, but also that the supervision will be lifted from the national level, so you no longer will be supervised by one of our member states, but you will be supervised directly by the European supervisory authorities that are located that are at European level. And for the case of stablecoins, that would be either the European Banking Authority, that would be the European Banking Authority that is located in Paris. So that is for stablecoins. Next part is crypto asset service providers. And this really are the people that are mostly visible towards consumers and market participants. Market participants, consumers, investors would rarely deal with issuers, but they would be confronted with crypto asset service providers. And so crypto asset service providers are people that provide services like custody, exchange services, client order execution, placement of digital assets, the typical services you also see in the financial sector. And all of these crypto asset service providers need to be authorized. They need to get a license to provide these services. And in order to get a license, they need to have proper governance requirements. They need to be fit and proper. They need to comply with asset segregation requirements, so they can't commingle the assets of their clients with their own assets. They have to manage their conflicts of interest. And so on. So there's a number of provisions which are common to all the crypto asset service providers. And then, and I will not bore you with it, there are specific provisions for the specific services. For example, trading platforms have a prohibition for own account trading. So if you are a provider of a trading platform, you are not allowed to engage in proprietary trading on your own platform, because that, of course, is, in our view, a recipe for disaster and is a massive conflict of interest. So these are the different kind of specific requirements that will apply to specific crypto asset service providers on top of the horizontal requirements. And then there's a number of final provisions which are not that interesting to understand crypto, other than the MiCA regulation doesn't cover everything under the sun. First of all, it doesn't contain substantive rules on anti-money laundering. All MiCA says is that if you are a crypto asset service provider as defined in MiCA, then you are also subject to all anti-money laundering rules set out in our anti-money laundering legislation. And you're also subject, if you engage in the transfer of crypto assets, in the transfer of funds regulation, travel rule from the FATF, and so on. Also, MiCA does only deal partially with non-fungible tokens, and there's lots of theory about which ones are covered and which ones are not covered. It does not deal with decentralized finance, so crypto assets which don't have an issuer, and crypto assets where there is no service provider, where there is no intermediary, and it doesn't deal with borrowing and lending of crypto assets or staking. So these issues the European Commission will study 18 months after the entry into force of MiCA, and that effectively means that we have to do a report at the beginning of 2025. So MiCA will come into force, the provisions of MiCA will come into force on stablecoins in June of 2024, and all the other provisions will come into force in December of 2024. So 1 year from now.
Apologies, Peter. We might have to transition over to Carol. But maybe I'll give you a quick moment to wrap up if there's any last words.
So no, I will wrap up because I'm at the end of the presentation. So as I said, in addition to MiCA, additional rules also apply: money laundering rules, cybersecurity rules, data protection rules, taxation rules also apply in addition to MiCA, of course. And this is the end of my presentation. So I almost made it within the time. Thank you.
Thanks so much, Peter. So next we have Carol Van Cleef joining us. Carol is the founder and CEO of Luminous Group, a consulting firm focused on strategic and compliance-related matters in the blockchain and fintech space. She has over 40 years experience as a lawyer and consultant in the financial services industry, including more than 20 years as a partner in AML 100 law firms. Ms. Van Cleef counsels a wide range of clients on blockchain, fintech, and related compliance issues. And she also sits on the board of a public company and several non-public companies in these areas. And with that, I will pass it over to Carol for your 15 minutes.
Well, thank you, Sarah, and thank you, Shlomo, for the invitation and the opportunity to present today. It's, to say the least, a very dynamic situation in the U.S. And in Washington, D.C. in particular, even today. And I hope that you'll be able to see the slides. I have an update on the Zoom, which has, or I guess the PowerPoint slides that has thrown a little bit of a monkey wrench here. But what I want to do is, to make sense of what's going on in the U.S., I like to start with the concept of bucketing the assets. What are we talking about? What are the issues around each one of the buckets that we're going to talk about? And who are the players that are really, well, as I have wading through the muck in each one of those buckets, and then talk about where we're headed to the extent that anyone can put on their glasses and look through the crystal ball in the U.S. The first thing that we have is we definitely have a challenge in the dialogue. And I think we see this in every country, probably, maybe more so in the US than elsewhere. But what are we actually talking about? We've got, we hear the terms cryptocurrency, crypto assets, blockchain technology. And each one of them comes with their own overlay. I'm not going to start to profess that I'm going to sort through those today, but I'm going to offer up a couple of, and it looks like my slideshow. Okay, here we go. See, maybe this will work better. There are different, lots of people have made many attempts to try to sort through the assets and put them into categories, which is incredibly important in the US because we deal with regulation by function. So categorizing the different types of assets is important. And I know this is a very difficult slide to probably see and a little bit build up, but we've taken different functionalities and even broken them down further into separate areas. And this is one cut that was taken by CoinDesk, which many of you are probably aware of as a major publication service in the crypto space. The way I like to do it is a little bit simpler. I like my buckets, real buckets, and you can see the categories that I've broken them out. Many of the categories that Peter's just talked about and laid a very nice foundation for my sorting process. So we have everything from the sort of the native currencies, the Bitcoin, Ethereum, to the stable coins, to the central bank digital currencies. It probably should be a bigger bucket than is for trade. Here is the security and other types of fungible tokens versus the non-fungible tokens. And then I have a very big bucket for decentralized finance because I think we're still in the process of really sorting through what that means as a concept. And all of the pieces that I just displayed to you in the other buckets actually come into play in some way or another. The technologies is what we're really talking about are being applied across different ways to really move towards a disintermediation of the traditional actors in financial services. So from the US perspective, and this is the way I deal with it when I put my lawyer hat on, is that in order to determine the regulation, and yes, we do actually have a lot of regulations in the US that do apply today, contrary to what you might read in the press. But you start with, what is the project? What's the nature of the product or service? Where is the project or developers located? Are they inside the US? Are they outside the US? If they're inside the US, then it actually becomes important for us to figure out whether they are also within a specific state in the US. And then where are the intended customers or users of this technology? Are they, and again, inside the US, outside the US, and then state specific inside the US? And then another factor is, are there intermediaries? Are there others who are playing in this game? And when we get to FTX, that becomes a very relevant issue. So I'm going to take another cut at the bucket and talk about who are the players that get into the middle of the bucket and start to muck around with it. And we obviously have the legislators. Our Congress is bicameral, so we have the House and we have the Senate, and they each have their own sort of composition and tenor. They make the laws. Sometimes the percentage of laws that actually proposed laws that make it to enacted laws is extraordinarily small, in the less than 1% category. But we have lots of hearings, we have lots of investigations, all sorts of things going on that play a role. And sometimes we even have our congressmen writing to our regulators to either hold them accountable for actions that they've taken or to ask them why they haven't taken action. And then I've taken a picture of the White House from above. It's a great picture because it really sort of gives you a good idea. We have in the US a system of checks and balances and a three-part process in government, which is the legislature, the administrative side, the executive branch, which the White House is the epitome of the representation of the executive branch, and then we have the judiciary, with 9 people who sit on the court who ultimately interpret the laws that have been made versus with the actions that have been taken in the administration, in the executive branch. And all of this is very relevant because all of these pieces right now are coming into play in the crypto space. I don't think in my 40 plus years in financial services, I've ever seen a time when I think all 3 areas are so actively engaged. The problem is, I think, from someone sitting outside the United States and even inside the United States, it can be very, very confusing. So I'm going to offer a little bit more, structure for sorting through this bucket. As I said, I just gave you a very brief overview, but now we're going to see that when we talk about securities issues, we look to the Securities Exchange Commission and the CFTC, our Commodities and Futures Trading Commission, who sort of split the responsibilities that in many countries are united in one regulator. And they deal with a range of issues from, the sale of securities, or what is a security in the U.S., to the operation of exchanges, to the role of advisors, investment advisors in this arena. I put up there second, consumer protection, which we have two major agencies that focus on that in the U.S. The Consumer Financial Protection Bureau, which focuses on what is regulated in the financial institution area, financial services generally, with the exception of securities. Any consumer protection laws are administered by the SEC in the securities area. And we also have the Federal Trade Commission, which is sort of a jack of all trades, which can cut across a lot of different areas. The jurisdictions here can be a little bit confusing because Bitcoin has been determined not to be a security, so it's outside of the SEC. And we're just starting to see this Consumer Financial Protection Bureau step in that arena. Banking regulators clearly play a major role in a lot of what's been happening over the last couple of years, as the banking industry in the United States is trying to move more intently into making use of the technology, if not necessarily providing access to the crypto assets that we saw earlier. And we have multiple regulators with, again, sort of multiple agendas. And you have to sort through very carefully to understand what they are and when they're going to come to the table. Then we have the Department of Treasury, which has a lot of different moving pieces under it. Most notable in this area are the Internal Revenue Service. It has not only, you'll see in a minute, I'll show you what all they have, but we have OFAC, our sanctions administrator, as well as FinCEN, our FIU. We have the Department of Justice, which is the prosecutor, plus the investigator with the FBI, and a number of other related investigatorial agencies. And then we have the Department of Homeland Security, which most notably between the sort of the pure Department of Homeland Security activities, we also have the Secret Service. And they also have Custom and Border Control. And all of these players have been playing a very active role in the world of crypto. And then we have a bunch of other agencies. And again, it does get very confusing very fast, especially in sanctions, in export controls. We have the Department of Commerce. And then last, and I won't say least, are the states. And the states, we sort of mirror a lot of what we have at the federal level, at the state level, which right there we start with, going from a handful of agencies to now 50 times however many other areas. If they have separate regulators for banking, separate regulators for money transmitters, separate regulators for securities, and then our state attorneys generals, all of these players get into the muck of our system. So what I want to do is give a little bit of a structure for navigating this maze. As I said earlier, when we ask what is the product, what is the service, what's the customer, we do that because we need to sort through and decide what of the federal laws versus the state laws are going to apply. And we have certain federal laws that apply to all U.S. persons, which sometimes it's hard to get the crypto space to understand that these laws already do apply, one of which is anti-money laundering. A lot of the crypto space focuses primarily on the Bank Secrecy Act. The Bank Secrecy Act is a very narrow statute, relatively narrow, I shouldn't say very, relatively narrow statute in the US. And there are a lot of crypto business models that have tried to engineer their way to stay outside of the Bank Secrecy Act. But, for all of their time and their effort, at the end of the day, we still have an overlay of the federal criminal statutes, which really get these companies to the same place where they should have an AML compliance program. They should be doing some level of customer discovery, whether you want to call it customer CIP or KYC or customer due diligence, plus the transaction monitoring. They don't necessarily have to file the same reports with the regulators, but they should be looking. Likewise with sanctions. Our sanctions laws apply to all U.S. persons, and it can be very confusing, especially for U.S. persons who have decided to locate in other countries and set up crypto operations because of more favorable laws. They often forget the fact that they are still subject to the U.S. sanctions laws, which is an extra overlay for their operations. Some areas are covered by both federal and state laws. We've seen this in the token area as to what is a security. We've had the Federal Securities and Exchange Commission weigh in, and we've had the states have been very, very active in looking at securities law issues under state laws. And sometimes we just have things that aren't covered by anything. And right now we're sort of sorting through some issues like staking, especially non-custodial staking in that regard. So as I said, type of activity is going to dictate the regulator, whether at federal or state law. And we do have, different sets of laws. And again, this has been very difficult. And I guess I had an advantage in understanding a lot of this coming as a banking lawyer to the table. I knew what the banking laws looked like. I also got involved very early on by 2008 in digital assets, in working with the founders of a gold-backed digital currency system that was prosecuted by the U.S. government. I was on the backside of that, but I also saw what the U.S. government at that point was trying to lay out. To be very honest with you, they really haven't necessarily followed through on all of the principles they tried to set out in 2008. And just now we're really catching up with the Binance order of recent days. The issue may also dictate the regulator, as I said earlier, pointing to the consumer protection piece. Just to give you an example of even further confusion is regulators have multiple functions. So the IRS, for example, is responsible for tax. It also has the criminal investigatory division, which has a very vibrant digital asset group that's been involved almost from the very beginning, if not the very beginning, in investigating criminal activity in the crypto space. We also have the Title 31 examination responsibilities under the Bank Secrecy Act. These are really the examination authorities under the Bank Secrecy Act. The IRS sort of picks up everything that the federal regulators don't pick up, the banking regulators, the securities regulators. The IRS picks up our money service businesses that are regulated at the state level and other states. And then we have they're doing rulemaking in the tax area, which is highly controversial at the moment. I thought I would sort of just very quickly say we've got a vicious cycle in the U.S. The U.S. is actually, I argue, probably the best place in the world to innovate still. The U.S. is very tolerant of experimentation without necessarily full compliance of the law until is when something happens. And at that point, then, the regulators are expected to act if they have the laws and regulations to be able to do so. Then if they do, then the industry responds. We have the legislative process that is there for the then angry industry that doesn't like how the regulators are responding. The regulatory process often promises more than it can deliver. As I said, very few laws that are proposed legislation that's introduced become law, but it's a great way to do fundraising for congressional campaigns in particular. I'm very cynical on that point. Crisis exposes our weaknesses. Certainly FTX is a great example of that, but we've seen that over the years in the banking industry. Crisis breeds, is the breeding ground for new laws and regulations. At the end of the day, the regulators are still left to clean up the mess. The regulators get criticized for their overreaction, end up backing off. Funding gets cut to the regulators. While Congress has said we never want this to happen again, because of those steps, we end up right back in our vicious cycle. So I'll leave that for you to ponder. As I said, FTX definitely exposed all of the weaknesses, and we've heard from time to time the complaints that the government's trying to kill crypto. And again, lots and lots have been in the papers. We've heard the complaints about crypto regulation by enforcement. I like to look at it a different way. In the US, we really sort of have an honor code. We have a system of laws and regulations, and it's really left to the individuals to become compliant with them. And it's only when they don't become compliant and problems arise, like my vicious cycle, that we see the regulators stepping in. And almost everything that we've seen happen, especially at the SEC and so on, has really followed that kind of model. So complaints of regulation by enforcement are really a bit distorted. And I've got some samples here that I won't go through, but these are some cases involving, Kraken, for example, has been before the SEC, they've been before the CFTC, they've been before OFAC. We've seen the state regulators with Coinbase. The SEC is still, bringing actions, including just 2 weeks ago or a week and a half ago against Kraken, again, another action. And this, in some ways, this particular issue is maybe the existential threat to the crypto space in the US, because right now, our exchanges have been, well, up until recently, have been allowing all sorts of tokens to trade, providing a lot of liquidity for a lot of players within the system. But that window is closing. We've seen the regulators come in and try to deal with the challenges around ransomware, using sanctions, new efforts in the wake of the October 7th attack, to come back at mixers, other mechanisms that are being used to confuse we'll get into mixers probably at some other point here. But I know time is short here, but what I want to let you know is that we do have legislation that's been passed. The first time that legislation to restructure regulation around crypto has passed in House committees, has not made it to the floor. Probably many of you are aware we've had some leadership crises in the US in the last couple of months. That definitely delayed the actions, because the people who were leading the effort in the House Financial Services Committee actually were very much tied up and on the short list of becoming the next speakers of the House. Also, the White House, and I should have mentioned this a little bit earlier, but the White House, the executive branch, a year and a half ago came out with an executive order, sort of a manifesto on the concept of responsible innovation, while very carefully pointing out a number of the different issues. And we've seen legislation that is definitely tracking that and actually making a fair amount of progress. But we have one senator who has been very vocal on the use of crypto in criminal activity. And to be very honest with you, since October 7th, she went from having a bill that had 2 or 3 sponsors on it to having over 100 sponsors, which is a lot, and has really thrown into question what is going to happen from a legislative front in the US. That right where we thought we looked like we were on a good path to getting some structural changes made to address some of the issues that we're dealing with, I would say that's been pretty much put aside for this year. What we now have is the real issue, and as of yesterday, the Treasury Department sent a whole set of amendments to Capitol Hill to change a number of our anti-money laundering laws, in part to address issues around the Hamas attack, but to go further. And I equate this with, and give you a little bit of an idea of how our system works, is that I have, by secondhand knowledge, I was told once that after 9/11, the Senate Banking Committee staff called up the Treasury Department and said, send us everything that you ever wanted to put into or make changes in the Bank Secrecy Act and in our sanctions laws. That package that was sent by the Treasury to Capitol Hill became Title III of the Patriot Act. When we talk about the Patriot Act today, that is really what happened. We're at that moment, that inflection point right now in the US. And what happened yesterday was exactly the same thing and the Deputy Secretary of Treasury before the American Bankers Association, or actually before a blockchain group yesterday, said it was the largest package of amendments, changes to our AML and sanctions laws that have gone to Capitol Hill since 9/11. So I know, I don't know how much
to jump in, Carol.
Okay.
Only since we want to leave time for other couple speakers. Maybe if you have any last closing remarks.
No, I've got some charts and so on here but the big issue is, I think what I just said is that with the Binance action last week, with the package that went to Capitol Hill yesterday, we're going to have an interesting duel that's going to happen between the blockchain industry and the administration over the next few weeks. And the only thing I expect is going to be meaningful change in the short term will be in the AML laws.
Thank you so much, Carol. Appreciate it. Next up, we have Ursula McCormick. Ursula is a regulatory and digital economy specialist with a focus on emerging technologies. Ursula is one of the leading blockchain, tokenization, and digital platform specialists globally, and has helped pioneer the creation of one of the Asia Pacific's most respected fintech practices. She runs a large cross-border team based in Australia and Hong Kong. She advises global banks, technology companies, crypto ecosystem players, and payment institutions on new products, cross-border transactions, financial services licensing, data sharing agreements, and global compliance. And with that, I will welcome Ursula for your 15-minute presentation. Thank you so much.
Thanks so much. And I'm going to gallop through APAC so that we've got lots of time for questions. And what I want to do is to give you an indication of some of the key themes to know about APAC, and then do a deeper dive into Hong Kong, which is, really, has been my focus over the past 12 months, with a bit of color on Australia and some of the other markets that are important to watch. First thing to know, obviously, is that the Asia Pacific region is not homogenous, by any stretch of the imagination. So we have everything from the world's most restrictive economy in relation to crypto, and that would be mainland China, right through to some of the most permissive. But what I want to say first and foremost, it is certainly not the Wild East. And in fact, Asia Pacific has had some of the earliest and most sophisticated approaches to the crypto sector and Web3, and certainly sees opportunities to embrace digitalization, to leapfrog, in certain instances, traditional phases of development, and really take a critical lens to this space. And some of that comes from needing to respond immediately to times of crisis. So Japan was quite an early mover. Obviously, there was Mt. Gox that was one of the first catalysts there. But others have moved along with the role of global standards. And the Financial Action Task Force recommendations have had probably the most significant impact. So the Philippines, one of the earliest movers, one of the very first, if not the first, that was tested by FATF on mutual evaluation against those new standards in relation to virtual assets. But others have a much more historical legacy of regulating with the lens of not just AML, not just because of international regulation, but because of a strong sense of protecting consumers. And that's where Hong Kong and Singapore have a long legacy of really focusing on consumer protection, primarily because of what happened during the financial crisis, where we had very significant impacts on everyday people from the collapse of Lehman Brothers. So what we see then in APAC are some very strong trend lines, and I want to really convey those trend lines to you, and then we can talk about some of the differentiators. And the key trend lines really are that we've we're following those key pillars of regulation. AML, of course, is front and stand as a center, and Philippines in particular faced scrutiny around the travel rule because travel rule technology was really not quite ready when Philippines was tested against those standards, and it had to then upgrade to meet them. But travel rule compliance remains a practical issue, but AML standards, travel rule compliance, are the first, key pillar everywhere that we see. The second is consumer protection. I talked about this in terms of Hong Kong and Singapore, but it's certainly not limited to those. So in my experience, Thailand was one of the very earliest, way before FTX. And I say way before in crypto years. So, we might be talking a year or two, but was one of the first that had banned the rehypothecation of assets held on exchanges. And that was really actually a very early move. And when you think back to that time, it was something that really not many people were talking about as a risk. And of course, we've come to know it as being one of the primary risks of such large markets. Indonesia was also quite early and in fact took a really novel approach in terms of designating and certain crypto assets as being approved, so to speak, for trading. So maintains a list and had for a while. What I would say about Hong Kong, and we'll come to this in a moment, is that it has, in my view, one of the most stringent regimes, but is narrow and deep. Singapore, by contrast, is much broader in terms of what it captures. It captures many more activities, and the depth of its regulation is slowly progressing along these consumer protection lines, but also was one of the first to look at retail advertising and really clamp down on advertising, even by its regulated institutions. Australia is also focused on consumer protection and interestingly folding into its capital markets regime. The third pillar is market integrity. So the controls on markets, and I listened with great interest to Peter's presentation around, the effectiveness, the purity of these large exchanges and their function akin to a large stock market, and really preserving the integrity of what they do and the narrowness of what they do and the controls around that. But not only that in terms of markets, but also in terms of the fundamental design of instruments. And we don't see, there's some exceptions. So Thailand is one where there is a focus on the issuance side. In general, we see much more of a focus on intermediaries, but certainly stable coins are a focus for the region in terms of the actual fundamental design. The fifth, of course, we're up to the fourth. The fourth is around penetrating decentralization. And that's where I think that Singapore is a really interesting case study, because we do start to see much more of an interest in bringing peer-to-peer technology itself, not certain non-custodial solutions into the mix. And, if you remember anything from today, Singapore is broad, Hong Kong is narrow and deep. This is really illustrative, because I think it's one of the very early markets that is really trying to reach out and embrace much more decentralized solutions into the mix. But I do have a fifth, and the fifth is experimentation. And I think that's one of the strongest stories that we have in APAC, really strong levels of experimentation by government in things like digital bonds. Hong Kong government issued one, CBDCs, with including live trials, as we saw in EAUD. But that experimentation is particularly nice, because it embraces technology, it experiments, it looks at use cases, but it does so collaboratively with industry. But in terms of Hong Kong, just to sort of set the scene here, the adage, that we hear time and time again is, same risk, same activities, same rules, same regulation. So you're really trying to embrace a really level playing field. And I do think that this is true of Hong Kong, because we have a regulator, the SFC, that is very focused on establishing rules right across its players. It established several years ago, before it had statutory authority to do so, an opt-in regime for crypto sector participants that wish to add a security token or plans for a security token and effectively bring themselves within the umbrella of the SFC. What was very valuable about that is enabled the SFC to learn a lot about the industry, to establish a regime, and that's really what we're starting to see now, what we have seen now, which is the very comprehensive regime that's in place for exchanges as of the 1st of June. So not only do we have licensing, we've got capital requirements, similar to the European standards around no proprietary trading, also no derivatives. But in terms of the most stringent controls that I see, it's really around the client asset protection. All assets must be on trust, held one-to-one in a special purpose vehicle that must be wholly owned. So it's a separate, wholly owned subsidiary of the exchange. We're not even sort of outside that mix. And then on top of that, so not only do we have one-to-one rules, we also have loss compensation that sits on top of that. So 100% of, covering a potential loss of 100% of assets in hot storage, 50% of that in cold, as well as a minimum of 98% of assets in cold storage. So really a really strong level of additional overlay. And that compensation component really echoes a depositor protection regime, although of course with a higher compensation amount. The other interesting thing about that is that it can be a combination of insurance, which is very expensive, and hard to get, or funds that are set aside, or assets that are set aside, or potentially also a guarantee. That piece, to be very frank, is expensive. So when we look at the sort of this as a framework, it is not for everyone. And so we actually do not expect there to be, really that many that get through. And that's a deliberately high threshold for what the SFC views as the most important piece of the puzzle for this stage. So it's very much focused on that. Having said that, the other thing that the SFC has done is issued with the HKMA a joint circular that sets the standards for the rest of its regulated intermediaries. So to give you a picture, if I'm a broker of simply Bitcoin, I do not necessarily need any license at all. I can sell to whomever I want. I can run my business subject to general protections, as I wish. But if I'm a broker of securities and I want to add Bitcoin, then I have all of these standards that I need to meet. And so that a complementary aspect of bringing in, same rules around sort of same or similar activity, is very much, live. And there's very stringent suitability and other rules that are in place there. And we're also starting to see the rules around custody now being implemented by the HKMA in relation to any banks that wish to custody virtual assets as well. What I would say, and as I think is a real highlight, there's two highlights I would make around the Hong Kong regime. One is that we've gotten to a point where ideally it does not matter whether or not you have a security token or utility token or a payment token or a nothing token, you have the same framework. And what I would urge all of you, if you're a policymaker and a regulator, to stress the importance of that, because it makes operationalizing these regimes that much more straightforward, and the controls therefore capable of being more robust because they're less complex. In all of the clients with whom I deal, that is very important. They don't want to be thinking about which bucket they need to be throwing, which asset. And one of the times where this became critically important was, of course, where there was the Ripple litigation in the US. Now, in my view, as a Hong Kong practitioner, that litigation wasn't going to necessarily change the regulatory treatment in Hong Kong. However, we had a lot of offboarding of XRP of many platforms, and that put consumers at risk. So the regulators really seen this as, we want to put people in a position where the regulatory treatment does not matter. yes, you have the right licenses, but the standards are effectively consistent. And so that was important. The second is banking. So there is a requirement that your fiat currency goes into a bank account, but in response to the fact that we have this issue of debanking, the Hong Kong regulators have been very proactive and have positive messaging to their banks, not just the generic risk-based approach, but effectively saying if you've got an exchange that is regulated as well, if not higher than you because of the travel rule compliance and on-chain analytics capability, you really need to think about banking them and really seriously consider it. And that has really changed the tone of the conversation in this market. The final things I'll say are really just about what I see as the potential risks of the next hype cycle. We obviously have predictions of Bitcoin going to remarkable levels, and ETFs on the horizon. But the tokenization of real world assets is the constant thing I'm hearing all the time. So that's another area where we've got now guidance from the regulator around its expectation of selection of technology and other controls in relation to tokenization, because I actually see that as a very real risk, because I get any number of stupid ideas, some remarkable, but some very much keen to make a quick buck off retail, off some very obscure receivable or underlying asset. So on that happy note, I'll pause there and yield the balance of my time to my other speakers, and very happy to answer any questions in due course. Thank you.
Thank you so much, Ursula. So next up, we have Thomas Harjano. Dr. Thomas Harjano is the CTO of Connection Science and is the technical director of the MIT Trust Data Consortium. He's an early pioneer in the field of digital identities and trusted hardware, and instrumental in the development and broad adoption of the MIT Kerberos authentication protocol. His activities include leading standard development efforts, notably at the IETF, IEEE, Trusted Computing Group, Confidential Computing Alliance, and others. He has published over 70 technical conference journal papers, several books, and over 30 patents. And with that, now that we've gotten a broad view of digital asset regulation approaches from around the world, we'll turn it over to Thomas to talk more about standard setting as well. Thank you so much.
Thanks, Sarah. Can you hear me okay? Okay. Yes, thank you. I wasn't expecting you to read the whole bio, but thank you. That was long. So folks, just a quick review. What's the vision of this sort of Web3 thing? And basically this is the movement of value across different networks. So this is just a very high level vision. Of course, the last bullet, all that stuff about security, stability, accountability, is really the hard stuff. And you've heard a lot about the hard stuff today, particularly from the legal and regulatory aspects. I want to talk about the standards, right? So just in the last 10 years of basically since Bitcoin sort of appeared, the word standards is sort of barely mentioned, even though it's a sort of core part of the digital economy. So if you are a business, if you are a startup, you're a medium-sized company, if you are a person in government whose job is to do procurement either for the federal government, state government, or defense, you will understand what these bullets mean. So for business, standards means that you have a better chance of increasing your business reach. Why? Because if you're trying to do a deal with a potential partner and so on, if you have systems that interoperate based on technical standards, you have less headaches, and you do this multiple times. Suddenly your network of customers and partners increases very easily. Internally, if you talk to any IT manager, any exec in Wall Street, particularly those who are dealing with the IT infrastructure, their primary goal every year is to reduce IT costs. And there's a saying in engineering that you want to code once and deploy everywhere, right? So that means you want to have one implementation that your engineers are doing, and you'd like to be able to apply this to all the possible partners, systems, and so on are outside your organization. And so the other benefit is that if there's new technology that appears in the horizon, such as blockchain technologies, DLTs, tokenized assets, you want a nice integration path into your existing IT infrastructure, right? I have to argue this many times. These big financial institutions, they put in tens of billions of dollars into their IT infrastructure. They're not going to rip that out and just replace it with blockchains next year, or in fact in the next 10 years. So there needs to be standards to allow this joining between old technology and new technology. And lastly, of course, you want standards because you don't want to be locked into particular vendors. And in the case of blockchains, you don't want your applications to be locked into a particular, let's say, ledger system, right? You'd like to be able to pick and choose based on the best performance of the network, of the blockchain, the best, return on investments, and so on. So these are just some of the areas of standardizations that we think need to happen. I'll focus a little bit on policy later on. Basically, there's sort of 4 layers there: policy definition, expression, and enforcement. So this barely ever gets mentioned. We have a whole bunch of legal policy definition work, but very few people are looking at how to express policy as rules, as syntax that can then be translated into rules on a smart contract, for example. That's my next slide. It's great to have Peter earlier today, because I love the work that the EU are doing in terms of the ART tokens. That work plays into this perfectly. So we use the technical term asset schemas and profiles, or prospectus, quite loosely. So that world needs to be standardized. So when a government in a particular European nation issues a definition of what is an asset, so that issuers can produce instances based on that definition. How do you do this on one or more or multiple blockchains? Secondly, for blockchains to operate, it needs to fetch information from the outside, these definitions, profiles. Is there a registry somewhere on the planet where I could look this up? So, put it simply, if there is a buyer of assets in Hong Kong, and it looks at this token on a blockchain somewhere, and it's got all these numbers and links, and say, how do I know that this is a legitimate asset? Like, where's the registry? When we just look at the serial number of this asset definition. Thirdly, big problem, digital identity, and this plays, of course, to what Shlomit said earlier, which is the travel rule. Part of the issue is that the data about the originator and beneficiary needs to be shared across VASP, or basically asset transmitters, and that introduces a number of interesting data privacy challenges. Fourthly, network. So today, this is 10 years after Bitcoin, more than 10 years, we still do not have network-to-network interoperability. I mean layer 1 to layer 1 interoperability. And so you hear these people start using fancy names like layer 2, right? And I keep saying to the layer 2 guys, okay, let's just solve the layer 1 to the layer 1 standards before you guys jump up to the layer 2. Tokens, we need technical standards, and if I wanted to implement an ART token, following Peter's work, where's the format for it? Where do I find that format? So this is another area of standardization. So seeing that the audience today, a lot of policymakers, this is some of the work that we did about 5 years ago, and this is the concept that there needs to be a almost contract-like syntax, a language that is just humanly readable, but more importantly, it's machine representable, that allows somebody who writes contracts or regulations to map that into these what I call pseudo code rules, right? So policy encoding is this is the middle layer. Why is this important? Because you want to be able to translate the same set of policies to different networks, and they have to mean the same thing, and they have to be enforced in the same way. So in this diagram, take that syntax and translate that into like a machine-specific language. If you're on Ethereum, it'll be Solidity. If it's on Tezos or some other language, could be different language. But the point is that when these machines enforce the policies, we should have the same effect, regardless of the network, regardless of the token format. A rule is a rule; it should apply and be enforced in different networks. The bottom layer of this diagram shows where the policy enforcement points should occur. So, if you have a token network, then you'll need gateways, and the gateways are a great place to enforce policies, because before a network receives a particular incoming asset being transferred into that network, it better check whether or not is the asset legitimate, is the originator legitimate, is the sending network also legitimate, right? And so by having this combined intake and exit of tokens that are always checked, and for nodes on the network to also check policy before processing using a smart contract, eventually you have what I will call clean asset networks. So basically, clean asset networks means that all the tokens are accountable for, all the actors are identifiable, all the movements of in and out of tokens and assets are logged, and so you can trace the origins of value that comes into a particular network. So this is some of the work that MIT has been working with the folks at the IETF. So the IETF is this large standards organization that deals with the internet. So virtually everything that we use today, Zoom session and all the nice stuff we use to, browsers, SSL to do shopping on Amazon and buy a Christmas present. That all came from the IETF. And so the IETF is a global standards organization. It has a lot of participants from Europe, from the Americas, and from Asia. And in fact, it meets 3 times a year. It's always once in the Americas, once in Europe, and once in Asia. So the recent early November one was in fact in Prague. So I think in March we'll be in Australia, in the Gold Coast, and I think we're back in Europe, I think in November next year. So this particular diagram is trying to show that in order to have interoperability at the network layer, you need a standard asset transfer protocol that provides guarantees such as no double spending, no loss of assets, no cheating, identities are verified, the entities that run gateways are identified. I mean, the idea that you can have anonymous people running anonymous nodes on a token network it has to go away. I don't think that can survive. I understand people are concerned about anonymity. There's a lot of crypto that allows you to do anonymity, but remain identifiable when you are challenged, legally. The second thing about this diagram is that interoperability needs to occur for different types of networks or systems. So you could have a private blockchain on one side and a public blockchain. You could do private to private, private to public, and of course monolithic systems. So those RTGS real-time settlement systems, they're not going to go away. Databases are not going to go away. We need to somehow interoperate those systems with the new blockchains, private or public. And this is just a bit about the IETF standardization process. It's been around 30 years. MIT's been active there since the early 90s. I'm kind of the second generation of MIT people who are going there. There's all these sort of older professors on campus that began attending, in the late 80s and early 90s. It has produced so far 8,400 plus and growing technical specifications. These are free for you to download. The working groups are free for anyone to join. There's no membership fee. You can join the mailing list. You can dial into the Zoom meetings. You can go if you fancy going to Prague or Australia. You can come and just sit and listen. And a lot of people do just sit and listen to the working group. An important thing about the written specifications, so all specs are written document, And this is important because if you're an IT procurement person within government or enterprise, you need to be able to say, okay, dear vendor, you have to implement this specification from the IETF and that specification, right? So having printed specs is important for all players in the ecosystem. For the IETF, before your document, your spec can become standard, you have to have 2 independent open source implementations. We believe that standards is not an area for business competition. You're not going to get advantage over your competitors, if you implement this standard. Something needs to be standardized if it's commodity, right? So you need open source implementations for possible competitors to even implement and compete against your product. The IETF is volunteer driven. Everyone there is volunteers. No one's paid, and the work is based out of sheer good engineering, and it does take a lot of debates and arguments to get good engineering, but that's unavoidable. If you are interested in this particular work in the IETF, the last 2 references there will show you the current status of this group. New work items are always being introduced. The latest one is the idea that you need to create this asset prospectus in a way that conforms with the EU MiCA regulation, the ART tokens, and you need this profile to be representable on the blockchain, so that when you have a smart contract that wants to process a particular token, it knows where to read, where to find the profile that's on the same blockchain or a different blockchain. And that profile needs to point to an off-chain regulation such as MiCA, so that whoever's trading this token knows that, oh, this token I'm about to buy is actually based on MiCA, for example. Anyway, so this slide should be available from Sarah and Shlomit, but I'm going to end my talk here so that to give everybody some time to have Q&A.